Greetings of the day. I am Professor Madhusudhanan, Assistant Professor, working in Department of Management, Kristu Jayanti College, Bangalore. Today, we are going to talk about one important concept which is there in all the minds of investors. In investors' perspective, this question will be there in all the minds. So, what is that question is all about? The question is, can I beat the market? Can I beat the market? Before going for this particular question, we want to discuss one important objective of investor is all about. So, commonly, the investor's objective is to minimize the risk and maximize the return. So, these are the two important objectives of every investors who are investing in a market. So, to reduce the risk and maximize the profit, we want to predict the market. To predict the market, the question arising in our mind is, could you able to predict the market? Can I beat the market? This is the question which is commonly prevailing in an investor's mindset. So it is not now. We have a trace back between 1939. This paper was published, and later this paper was revamped by Charles H. Dow. So the question with us is, can I beat the market? Can I earn more profit? Could I able to predict that market to earn more profit? All these questions are answered by the subject which is called as security analysis and portfolio management. So today's topic we are taken from security analysis and portfolio management. So the first question what we are going to answer is, can you identify the trend in a market? Sir, can you identify the trend in a market is a very sensible question. Why? Because if you identify the trend, you can have a chances to beat the market. So, is there any chances? Can I able to identify what is the trend prevailing in a market? So, what is this trend is all about? How we can identify this trend? The answer by Dow Theory. Coming back, this Dow Theory is clearly explaining that yes, we can able to identify the trends which are prevailing in a market. How and how we are going to identify the trend in a market is what the discussion today is. So, coming back, the Charles Henry Dow, the 19th century, mid of 19th century, has proposed a theory which is called as Dow Theory. The theory is fundamental principle of technical analysis. When we talk about a technical analysis, before that we want to understand, can I beat the market? The market can be beatable. How we can beat the market? We have two different analysis. The security analysis is suggesting to us. What are those two analysis is all about is? One is fundamental analysis, another one is technical analysis. The Dow theory comes under the category of technical analysis. Before going for the technical analysis, just for the benefit of all, I would like to talk something about this fundamental analysis as well. The fundamental analysis consists of three different components. What are those three different components? One is economic analysis, second one is industrial analysis, and the third important component is company analysis. Put together, we call it as EIC. So, each and every component is very much important before you go for an investment strategies. Coming back, the second important aspect what we are going to talk about is technical analysis. What is this technical analysis is all about? The technical analysis talks about chartisms and various mathematical and statistical tools to understand, to predict and to forecast what is happening in the stock market. So Dow theory is one of the fundamental principles of technical analysis which is widely used to identify the overall trend what is happening in a market. It is developed by Charles H. Dow in the mid of 19th century. There is no wonder in the 19th century itself, the curiosity of this particular question is there prevailing in all the investors' mindset. So coming back, what is this theory talks about? What we are going to learn from this particular theory. The Dow theory is a technical analysis approach as we talked about earlier, and it explains the concept the stock market moves in the trend that we can able to analyze and predict it. The question is answered, ladies and gentlemen. What is that question we are having in our mindset? What the question we are having in our investor's mindset is this. Can we able to identify the trend? Yes, we can able to identify the trend. After identifying the trend, what we want to do, can we able to analyze something from the market? Yes, you do. And the third important factor, which is more important for an investing point of view, is can we able to predict the market? Yes, that is also possible. So this theory gives a confidence that the market is moves in a trend and it can be analyzed and it can be predicted too. So this is one of the greatest important identification by the Charles Dow. And it provides the framework understanding the market behavior and making informed about the investment decision. Most important thing is after knowing this trend, after analyzing the trend, after predicting the trend, it is very much important that the investors has to take a decision whether and where they are going to invest, how to pick up the stocks, how to pick up an investment opportunity. This is very much important. So precisely this Dow theory very clearly helping the investors to take an investment decision by analyzing the trend and predicting the trend as well. The same theory was published in a Wall Street Journal created by Dow Jones Industrial Averages. As of now, we have a small ambiguity on what is this Dow Jones Industrial Averages is all about. So I slightly want to give an introduction about what is this Dow Jones Industrial Average is all about. In the paper which is published by Dow Charles, he is very clearly mentioning that he is comparing two different indexes. One is Dow Jones Industrial Average and another one is Dow Jones Transportation Averages. Both these indexes are clearly analyzed and predicted and come with a conclusion that there is a correlation. How that correlation works, we will talk about that in the next slide. And the Dow theory is based on the idea the stock market moves in a three different trends. This is the theory. Basic theory is all about the stock market moves with three different trends. What are those three different trends, sir? The three different trends starts with the first trend, which is called as a primary trend, and the second one is what we call as a secondary trend, which is called as a corrections as well, and the third trend is what we call as a minor trend. What is this trend? What these trends tends to tell to us? All these things in a detail we will discuss. This theory emphasizes on importance of volume conforming price movements. Very important aspect to identify the trend. Volume plays then very much important aspects. What is this volume, sir? The total number of sales happened in the particular market is what we call as an volumes. And how this volume is determining this price movement, sir? And Charles is giving two different options. If the price is rising with the rise of volume, then the market is bullish. Very precisely he is telling that when the price is rising with the volume, then it is considered to be a bullish market. In contradictory to that, when the price is falling with the volume, the market is considered to be a bearish market. So whether the market is a bullish market or bearish market determined by the volume. Second important factor, sir. The first and foremost thing, yes, the market have three trends. The market moves with the three trends. One is a primary trend, second one is a secondary trend, and the third one is what we call as a minor trend. And the second important factor is the market or the trend moves with a volume. The prices are determined, the market trends are determined by the volumes. How the volume is determining these prices, sir? The next question comes to our mind is, if the prices moves along with the volume, price is also increasing, volume is also increasing, market is considered to be a bullish sign. The price is falling along with the high fall in the volume, the market considered to be a bearish sign. So this is the market trend which we are talking about. Dow Jones is clearly stating that the primary market trend is overall directions in a market which clearly lasting for several years. So primary trend talks about longer period of time. And the secondary trend talks about, it is called as an corrections. So most of the investors know what is the technical term which is called as an corrections. In a market scenario, the corrections is nothing but if the market moves more than 10%, if the market decreases more than 10%, the prices corrects itself because of the two market forces which is called as the demand as well as supply. So because of supply, or demand, or both demand and supply, if the market corrected itself for more than 10%, then the market is to be the secondary market or the correction market. The third important trend is what we call as daily fluctuations in a market. Particularly, the market is always having a fluctuations. The minor trend talks about the short-term fluctuations in a market which can be last for several days. Once again, the primary market or the primary trend talks about several years, that is, longer period of duration. The secondary trend talks about several months it will prevail, and this is also called as a correction period. The third trend, which talks about the fluctuations in a market which is happening in a day-to-day manner. This prevails for several days. So this is what the three trends which is proposed by the Dow. Coming back, why this theory is important, sir? What I can learn from this theory, sir? Very importantly, understanding the market trend. From the Dow theory, we could able to understand the market is having three trends. With the help of three trends, we can identify how the stocks are moving towards. And the second point is very much important, ladies and gentlemen. The identification of stocks talks about the three different trends. Out of these three different trends, how you are going to pick up the stocks is very much important. That is what the very primary slides we are talking about. The Dow theory helps for a decision making, and the Dow clearly states that it is a technical analysis. Why we can go ahead with the investment decisions with the help of these trends. And the third important factor is it is a technical analysis, and with the help of this Dow theory, we can go for a risk management, risk mitigation strategy. We can use this trend as a tool, as a technical analysis for mitigating our risk. Sir, we talked about two different components. One is profit maximization or return maximization, and the second important factor what we talked about is a risk minimization. So risk minimization is possible through this Dow trends, and it is a long-term investing factor. In a short trend, this will not work. Why? Because the primary trend prevails for a longer period of time, and the secondary trend prevails for a certain period of months, and the minor trends talks about few days. So when we go for an investment talks about the long-term scenarios. So long-term, this Dow theory helps us to mitigate the risk and maximize the profit as well. What are all the key principles of Dow theory? What is the assumptions this Dow theory is having? The market discounts everything. Sir, after the Dow theory, we have a lot of other theories are also coming up, lined up, which talks about the market discounts everything. This is also once again a very big question in all the investors' mindset, whether the market discounts everything. What it means the market discounts everything? What is meant by discounts? Why the market want to discounts is a very big debate. Again, in a simple sense, to understand in a clear manner, the market discounts everything means the information which are freely available in a market will be accepted by the market always. What it means, sir? Can I give more clarity on that? Whether it is a good information, whether it is a bad information, whether it is a corporate information, whether it is an economic information, whether it is related to budget, whether it is related to political or geopolitical informations, all these informations which are freely floating in a market is affecting the stock prices one way or other. That is what each and every theory clearly stating forward that the market discounts everything, means the market accepts all the available information. By the same time, it is not only accepting all the available information which are freely available, the market accepts the information which comes from the insider trading as well. So we can't able to deny that the market will not accept all this information. Later part of time, if we talk about this efficient market hypothesis, the word efficiency talks about the informational efficiency, just for the clarity. The second important factor, the market has three trends. The three trends determined by the volumes which are prevailing in a market. And the third one, the trend confirms your decision-making criteria. So whether I can buy this particular script can be determined by the trends which are available in a market. Once again, the volume confirmation is very much important. Why this volume confirmation is important? The volume confirmation determines the trend. When the price moves along with the volumes, high prices and high volumes, the market to be a bullish market, lower price to the lower volumes confirms that market to be a bearish market. And this is the limitations. Every theory is having assumption, every theory is having a limitations as well. So what are all the limitations of this theory? The first and foremost the limitations which talks about the Dow theory is the theory focuses on price movements. Why? We are not talking about any other elements. What are those any other elements? Informational efficiency. We are not talking about any other factors which are affecting this particular market. We focuses only on price moments. And the price moments are also confirmed with volume moments. And the second important disadvantages for this particular theory is it totally relies upon the closing prices. How these prices are taken. We have different prices which are available. If you download any company's data from a money control or tradingview.com, you get 4 different prices. One is opening price, second one is high price, third one is low price, and the fourth one is closing price. All these price movements are calculated or considered only the closing price. What is wrong with the closing price? Nothing wrong in that closing price. Very recently, we are having the investors or the analysts or the business analytical people are having an idea that we can take high opening, low closing averages that is more closer towards the predictions. So rather than taking a closing prices, only taking a closing prices, it is always better to have the averages. So one limitation for this particular theory is this theory considered only the closing prices. They are not considering about high, low opening. Why it is very much important? When we take a decision or when we take a predictions, the deviations will be more if we take only the closing prices. Coming back, the third point which is clearly talks about the over-reliance on historical data. Sir, the question what is in our mind is, can we able to predict the market? How we are going to predict the market? The prediction of market comes from the historical prices. There is one small hindrances in this particular point. Why historical prices? We are relying more on historical prices is, there is a common trend prevailing in the market is history repeats itself. One major aspect is the history repeats itself. What is this history repeats itself is? The market follows a separate pattern. The market follows a separate trend. So, all these analysts, all these theories or beliefs that there is a pattern prevailing in a market, we can't able to go with a random walk. Once again, if time permits, we will talk about random walk in a separate session as well. So, the third point talks about over-reliance on historical prices. Even though we are going to predict the market, the prediction comes from the historical prices. Once again, if there is no trend prevailing in a market, this theory will not work. And the theory talks about it's all subjectivity, there is no objectivity. Why? Because any theory which is having more assumptions will be a subjective theory only, sir. It depends upon person to person, it depends upon individual person, it depends upon analyst, it depends upon investors, it depends upon the various people. And the last one talks about delay due to lagging indicators. We have advanced indicators, we have lagging indicators. All these indicators are not considering in this particular theory. And this is how this Dow theory very clearly stating that yes, we can able to predict the market. How we can able to predict the market? We can predict with the analysis. How do we do the analysis? We can able to identify the trend which is prevailing in the market. So it is very easy for us to identify, predict, analyze the market as well. With that note, it is very much happy and pleasure for me to discuss this Dow theory with you. Thank you so much.